Imagine being profoundly dyslexic in the 1950s.
Oh, wow.
Yeah. I mean, an era where nobody even really knew what that word meant,
Yeah,
right?
they probably just thought you were, slow or lazy.
Exactly.
Yeah.
And every time you try to look at a book, the letters are just this torturous, jumbled mess. But then you add to that the fact that you are entirely blind in your left eye.
Which is just, that's a massive physical hurdle.
It is. And you're half blind in your right eye, too. So you literally cannot see the world clearly to the point where you are constantly, physically walking into walls.
Right.
You're failing in the classroom. You're failing on the playground. You are failing at basically every standard metric of childhood success. And there's this detail where your own mother is weeping to the neighbors because she genuinely thinks you are doomed to poverty.
It's incredibly bleak.
It really is. But so imagine taking those exact disabilities, those exact deficits, and somehow weaponizing them to build a billion-dollar hedge fund empire.
It sounds like, the plot of a movie or something. But it's actual financial history.
Yeah.
And the mechanism of how that happened is exactly what we're tearing apart today.
So welcome to today's deep dive. Our mission today is to completely deconstruct the life, the mind, and the intensely unorthodox philosophy of Larry Hite.
Yeah, and we've got a massive stack of sources on the table for you today.
We really do. We're pulling heavily from his autobiography, The Rule, How I Beat the Odds in the Markets and in Life, and How You Can Too. And we're pairing that with the groundbreaking historical market research conducted by his team, specifically Alex Gracerman and Catherine Kaminsky.
Right. Plus, our own compiled notes on game theory and probability.
Exactly. But we need to clarify right out of the gate.
Yeah.
If you're tuning in thinking this is going to be a dry technical manual on portfolio diversification.
I'll just standard Wall Street advice.
Yeah. If you want that, you need to throw those expectations out the window right now.
Totally.
Yeah.
This material operates on a completely different frequency. It is fundamentally a survival guide for life that just happens to be disguised as a trading memoir.
Right.
We're going to look at how someone succeeds, not by predicting the future, and definitely not by being the smartest person in the room.
Right. It's almost the opposite.
Exactly. It's about mastering the cold, hard mathematics of failure.
So by the end of this conversation, you're going to learn why everything you've ever been taught about, the golden rule of buying and holding your investments might actually be a recipe for disaster.
Yep.
And you're going to see why being a certified straight-A genius is arguably the biggest disadvantage you could possibly have when dealing with risk.
Which is wild to think about.
It really is. We'll show you how to take the raw mechanics of probability and use them to completely hack everything from your retirement account to your dating life.
But, to grasp how someone wins on a billion-dollar scale like this, we have to start in the mud.
Yeah, we have to go back to Sheepshead Bay.
Right, Brooklyn. In the 1940s and 50s, we have to understand why starting with a deck stacked so aggressively against you is actually the ultimate competitive edge.
That environment is so crucial because the sensory experience of Larry's early life is just completely defined by limitation.
Yeah, there's that part in the text about the eye exams.
Oh, right. When the school would line the kids up for standard eye exams, he couldn't even see the giant E at the very top of the chart.
The physical coordination just wasn't there because the depth perception wasn't.
Right. And there's this incredibly poignant detail from the source text that really anchors the emotional weight of all this.
About his parents.
Yeah. His mother is so overwhelmed by his constant struggles that she genuinely believes he'll never be able to make a living. She thinks he's just fundamentally broken.
Which is heartbreaking.
It is. And meanwhile, his father, who, by the way, is a guy who never finished high school himself and is struggling to keep this bedspread manufacturing business afloat, he takes young Larry aside and puts this staggering ultimatum on him. He explicitly tells this physically and academically struggling kid that he expects Larry to support them in their old age.
Just place yourself in the shoes of a child hearing that.
I can't even imagine.
It's a crushing psychological burden.
Yeah.
But this is where we see the first real divergence between a standard response to trauma and Larry's response.
Because it didn't break him.
No, not at all. That intense pressure combined with just persistent daily failure, it didn't crush him. It created this massive burning engine of what the book calls want.
Right. The desire just took over.
Exactly. There's a specific moment the book highlights. At just 7 years old, an adult asks a group of kids what they want to be when they grow up.
And you get the standard answers right. A fireman. A doctor.
Right, a teacher. But Larry looks at the adult and says, I want to be rich like my uncle.
Which is just wild for a 7-year-old. Kids that age usually want to be astronauts, not venture capitalists. Seriously. But he didn't even have a conceptual definition of high finance yet. All he knew was that his uncle had a big house, and his own family lived in a cramped, stressful apartment.
So he viewed wealth differently.
Yeah, he didn't view it as a status symbol. He viewed it as a mechanism for freedom, and more importantly, as armor.
Armor. I like that.
Right, because if he couldn't rely on his eyes to see danger, or his reading ability to navigate the standard academic path to a career...
He needed resources.
Exactly. He needed a shield to protect himself from a world that wasn't designed for him.
And because he couldn't rely on his physical senses, he developed this incredible reliance on his imagination just to survive the day-to-day.
He basically started faking his way through childhood.
He really did. The text gives this great anecdote where the neighborhood kids would be outside and someone would point up at an airplane high in the sky.
And he couldn't see it.
He couldn't see a thing. It was just a bleed blur to him. But he didn't want to be the weird, broken kid every single day, so he would just nod, smile, and pretend he saw the exact same plane. That's classic survival masking.
Yeah. And later on, he takes this survival mechanism into the classroom. He's in a high school current events class. He hasn't done the reading because of the severe dyslexia.
Naturally.
And the teacher calls on him to present a news story. Having absolutely nothing prepared, he just stands up and completely fabricates a story out of thin air about a brand new 500-mile-per-hour airplane.
He just makes it up on the spot.
Completely. And this is the kicker. The other kids chime in and claim they read the exact same article. The teacher buys the whole thing.
It's a brilliant early adaptation.
Okay, let me stop you there, though, because when I was reading that part, I couldn't help but think, wasn't he just lying?
Well,
I get it as a childhood survival mechanism, sure, but we're framing this as the origin of a brilliant financial mind. He's just fabricating facts to get out of trouble. How does making up stories translate to understanding global markets?
That's the exact right question to ask. Because on the surface, yes, it's just a kid lying.
Right.
But look at the deeper psychological mechanism he's uncovering here. What Larry learned in that classroom wasn't just, how to get away with a lie.
Okay.
He was experiencing a masterclass in human fallibility. He realized in real time that human beings will eagerly buy into a convincing, competent narrative over actual verifiable facts.
Oh, wow. So he saw the Matrix, basically.
Kind of. Think about it.
Yeah.
Why did the other kids agree? Because they wanted to look smart. They wanted to appear informed in front of the teacher.
Right. They didn't want to look like they missed the news.
Exactly. And why did the teacher believe it? Because the consensus of the room validated the story.
That makes a lot of sense.
Larry discovered that the world isn't this rigid, perfectly objective place governed by pure logic. It is wildly subjective, and it's driven by human ego, fear of looking stupid, and groupthink.
So he's realizing that the quote-unquote smart people aren't actually operating on facts. They're operating on feelings and social proof.
Precisely. He realized he could use his imagination to navigate human systems that weren't built for him.
Which perfectly sets the stage for the New York State Regents exam.
Oh, this is a highly cinematic moment in his early life.
It really is. So he is completely flunking biology. The teacher tells him flat out, you have failed the coursework. The only mathematical way you pass this year is if you get a perfect 100 on the standardized state test.
Which is supposed to be impossible. I mean, if you can't read the textbook, you can't learn the biology.
Right. But he aces it. He actually gets the 100.
Yeah.
And the method he uses is just fascinating.
It's all about probability.
Exactly. He looks at the test and realizes that a multiple choice exam isn't actually a test of biological memorization. It's a rigid system. And like any system, it can be hacked.
This is his real initiation into practical game theory.
Tell me more about how he saw that.
Well, he looks at a multiple choice question. There are 5 options. Now, because he had spent so much time observing human behavior, like with the fake airplane story, he knew how test makers thought. He realized that out of 5 answers, usually 2 of them are completely absurd distractions. They are obviously wrong to anyone applying basic common sense.
Right, they're just filler options.
Exactly. So, without knowing a single thing about cellular mitosis or whatever, he eliminates the absurdities. He immediately reduces his odds from a 1 in 5 random guess to a 1 in 3 calculated bet.
And he didn't stop there either. He got his hands on old test questions, put them on index cards, and just memorized the patterns of the answers. He didn't learn biology. He learned the mechanics of the test itself.
Because he had failed so much in his life, he wasn't burdened by the ego of needing to be, quote-unquote, smart.
That's a huge point.
A straight-A student tries to prove they know the answer. Larry just needed to survive the system. And this intimate comfort with being wrong, this daily reality of failing, allowed him to build what he calls an assumption of wrongness into his entire operating system.
That phrase, the assumption of wrongness, is really the bedrock of everything we're talking about today.
It absolutely is.
The book brings in this great quote from J.K. Rowling's Harvard commencement speech to illustrate it. She talks about how hitting rock bottom, how experiencing massive failure meant a stripping away of the inessential.
Right, the ego.
Yeah. When you know your flaws intimately, when the worst has already happened to you, you stop pretending. You stop burning all this energy trying to protect this fragile, perfect image of yourself, and you just start dealing with raw reality.
Which is a superpower. Most people, especially highly educated professionals, they build their entire self-worth around being right.
Definitely.
They need their predictions to be correct, to feel valuable. But when you build your life on the assumption of wrongness, you stop trying to predict the future with absolute certainty. You stop relying on arrogance.
You just accept that you're going to be wrong a lot of the time.
Exactly. You accept that you're going to be wrong a significant portion of the time, and you start looking at the world as a series of calculated bets, where the goal is simply to survive your inevitable mistakes.
So let's look at how that translates into actual wealth. Like, how do you take an assumption of wrongness and turn it into millions of dollars?
It starts with an epiphany.
Right, in a college finance class.
Yeah.
So Larry had scraped his way into business school, which he absolutely hated, by the way, and he's sitting in this lecture. The professor starts talking about commodities traders.
And the professor's presenting them as a cautionary tale. He's essentially mocking them to the class.
Right. The professor says these crazy guys trade on a 5% margin, meaning they only put up 5% of their own cash, and they borrow the remaining 95% from the broker to make these massive trades.
And the whole class erupts in laughter.
Yeah, the students think it's the most reckless, stupid thing in the world. But Larry's sitting in the back, and his brain just lights up.
Because the rest of the class was listening to the professor's narrative, the story that commodities are crazy and risky.
They bought the story again.
Exactly. But Larry was ignoring the story and just doing the math.
Walk us through that math, because it's brilliant.
Okay, so he saw that if you want to control $10,000 worth of goods, you only need to put up $500 of your own money. That gives you massive leverage.
Right.
But here is the secret mechanism the rest of the class completely missed. That $500 doesn't just disappear. It sits in a margin account, which is usually invested in treasury bills.
And back then, those T-bills were earning about 3% interest, right?
Exactly. Meanwhile, the broker charging you for the borrowed money might charge 5% interest on the loan. So you're earning 3% on your deposit and paying 5% on the loan.
So the actual net cost to control $10,000 worth of assets is only 2%.
The money is practically free.
And he didn't need high-level calculus to see it. It was just basic arithmetic. He realizes he doesn't need to be born into a massive, wealthy empire to play in the big leagues. He just needs to borrow cheap money.
But he also knows he can't just gamble wildly like a degenerate.
Right, because if he loses, that leverage works against him just as fast. It amplifies the losses.
Which leads to his absolute game-changing framework for looking at risk. He realizes there aren't just good bets and bad bets. There are 4 distinct quadrants.
Okay, lay them out for us.
Good bets, bad bets, winning bets, and losing bets.
I really want to dig into this because when I first read this part of the source material, I had a major mental block.
Oh, really? How so?
Well, Wall Street and our culture in general really celebrates the massive risky win. We make Hollywood movies about the guys who bet their entire firm on a single short position against the housing market and win big.
Right, the big short.
Exactly. So my instinct is, if I place a bet and I walk away with $1 billion, isn't that automatically by definition a good bet?
I completely understand the instinct, but mathematically and philosophically the answer is no. Strongly no.
Okay, explain that.
This is the specific trap that destroys so many people's lives and portfolios. You have to divorce the action from the result. A good or bad bet is entirely about the odds and the risk of ruin before the outcome ever happens.
So the outcome doesn't matter.
A winning or losing bet is just the outcome. And the outcome does not validate a bad process.
Walk me through the math on that. Give me an example.
Let's look at the text's logic here. Imagine someone offers you a coin flip. True 50-50 odds.
Okay.
The rules are, if it's heads, you lose $1. If it's tails, you win $2. That is a spectacularly good bet.
Because you're risking almost nothing to potentially double your money.
Exactly. You should take that bet all day long. Now let's keep the exact same 50-50 odds, but change the stakes. If it's heads, you lose your entire life savings, your house, and your retirement. If it's tails, you win $1 million.
Oh, wow.
That is a catastrophic, universally bad bet, because even though the odds of winning are exactly the same, the downside completely wipes you out. You cease to exist financially.
It's the plank analogy from the book.
Yes.
If I put a wooden plank on the floor of your living room and say, walk across this and I'll give you $1 million, that's a good bet. The risk of falling and hurting yourself is basically zero, and the upside is huge.
Right.
But if I take that exact same plank and put it on the 50th floor between two skyscrapers on a windy day in Manhattan, that is a terrible bet.
A horrible bet.
The potential upside is exactly the same, $1 million, but the downside is literal death.
And if you walk across that plank on the 50th floor and survive,
Yeah.
you didn't make a good bet. You made a bad bet and just had a winning outcome.
That brings up a really profound danger in how we process luck, doesn't it?
It really does. The most dangerous thing that can happen to a human being is to make a bad bet and have a winning outcome, because it reinforces terrible behavior.
The text uses a very modern example for this, walking into a busy, multi-lane intersection without looking up from your phone.
We've all seen people do it.
Yeah, that is an objectively bad bet. The odds of catastrophic ruin are high, but let's say you do it, you don't look, and you make it across completely unscathed. You just had a winning bad bet.
And your brain rewards you for it. You get the dopamine hit of saving 10 seconds of your commute.
Exactly. It feels great, and it secretly desensitizes you to the risk. You subconsciously think, oh, I'm good at crossing the street while texting. I have special reflexes. The rules don't apply to me.
So you do it again on Tuesday.
Right.
You do it again on Wednesday. You are playing a game of Russian roulette until eventually probability catches up with you, the cars aren't paying attention either, and you get hit by a bus.
And in finance, people do this constantly.
Oh, all the time.
Yeah.
They bet their entire net worth on a single crazy crypto token or a hot stock tip they found on Reddit. They get incredibly lucky. They make a fortune. They think they're visionary geniuses.
And then they double down and do it again.
And the second time, they lose absolutely everything.
Which Larry actually experienced firsthand early in his career. He calls it the corn catastrophe.
Yes, this is a pivotal moment for him.
So he was a young broker, and he took a hot tip from a colleague about a corn trade. The colleague sounded smart, rattled off a bunch of convincing statistics about corn supplies, so Larry trusted him.
Which is trusting the narrative again.
Exactly. He went all in, heavily leveraged on margin, without doing his own rigorous probability research.
He violated his own emerging philosophy. He bet far more than he could afford to lose if the trade went against him.
And it went against him in a completely unpredictable way. There was this completely unexpected widespread rain across the agricultural belt.
Right, a weather anomaly.
It caused a record crop yield, which meant a massive oversupply, plummeting the price of corn.
And because he's highly leveraged on margin.
It's a disaster. The book paints this visceral, unforgettable scene. Larry is watching the ticker tape minute by minute as his money just vanishes. Because he's on margin, he is on the verge of owing far more money than he actually possesses.
It's not just going to zero, it's going into negative ruin.
Right. So he walks out of his office, physically shaking, goes into the concrete stairwell of the building, and literally drops to his knees.
He's desperate.
He's begging, praying to whatever's listening. Please, just get me out of this even. I don't care if I don't make a single penny of profit. Just let the price tick up enough so I don't go into ruinous debt.
And then the Swiss businessman.
Yes. Right in the middle of this breakdown, a group of very serious Swiss businessmen walk down the stairs and find this guy in a frumpy suit, kneeling and weeping in the stairwell.
It's a moment of dark comedy now.
Yeah.
But in that stairwell, it was pure terror for him.
I can't even imagine the panic.
Well, the market did eventually rebound just enough by a stroke of pure luck for him to break even and close the position.
So he survived a bad bet.
He did, but the psychological scar was permanent. The takeaway here forms the absolute foundation of his entire life philosophy.
What are the rules he pulls from this?
Rule number 1, you have to get in the game. You cannot win the lottery if you refuse to buy a ticket. You must expose yourself to opportunity.
Makes sense.
But rule number 2, which supersedes everything else, never ever lose all your chips.
Never lose all your chips.
Because if you lose all your chips, you cannot place a bet tomorrow. You are exiled from the game entirely.
But that creates a massive tension, doesn't it? How do you make sure you never lose all your chicks while still aggressively trying to capture the massive upside of the market?
It's a tightrope walk.
How do you actually execute that mathematically? Well, we have to look at the namesake of the book to find out. We have to look at the rule.
Right. To understand the rule, the sources take us back to the 19th century, to a man named David Ricardo.
Okay, who was he?
Ricardo was a brilliant British economist who amassed an absolute fortune doing something incredibly difficult. He successfully bet on the outcome of the Napoleonic Wars, specifically the Battle of Waterloo.
Wow, okay. And Ricardo had a golden rule, which Larry Hite adopted as his absolute gospel. It's a single sentence. Cut short your losses and let your profits run on.
It sounds deceptively simple, almost painfully obvious, right?
Yeah.
Everyone wants to cut losses and keep profits.
Yeah, it sounds like common sense.
But executing it in real time requires a complete, violent rewiring of human psychology. This single sentence is the essence of a strategy called trend following.
Let's break down the actual mechanics of what that means, because I think people hear trend following and misunderstand it.
They absolutely do. Trend following is emphatically not about predicting if a market will go up or down. Prediction implies you know what the future holds, which is arrogance.
And we know Larry avoids arrogance.
Right. Trend following is entirely about reacting to the present reality of what the market is doing right now.
When I was trying to wrap my head around this, I kept coming back to a surfing analogy.
Oh, that's a good one.
Think about it. A surfer doesn't sit on the beach with a calculator trying to magically predict exactly where the ocean is going to form a wave or exactly how high it will be based on lunar gravity.
That would be a waste of energy.
Exactly. They paddle out into the chaotic water and they watch the swells. When the water actually starts rising, when the present observable reality shows a wave forming, they paddle hard, they catch it, and they ride the momentum.
And then what happens?
The absolute second that wave starts to break and loses power, they bail out. They cut their loss. They don't sit on the board trying to force a dying wave to keep going because they predicted it would last longer. They react to the water.
That analogy maps perfectly onto the math. You aren't creating the momentum, you aren't predicting it, you are just reacting to the current flow.
So how does a quant do that with numbers?
In quantitative terms, trend followers rely heavily on Bayesian statistics.
Right.
For those unfamiliar, Bayesian probability is a way of continuously updating your beliefs as new evidence arrives.
Like a weather forecast.
Perfect example.
Yep.
If you wake up and the forecast says there's a 10% chance of rain, you might leave your umbrella at home. But an hour later, you look out the window and see dark, heavy clouds rolling in.
You don't stubbornly cling to the 10% forecast you heard this morning.
Right. You update your probability based on the new observable evidence. It's now highly likely to rain. Trend following applies that to the stock market.
So they aren't looking at fixed history.
No, they don't look at a fixed historical probability. They constantly update their probabilities based on the new information of the right now. If a stock price has been going up for 50 consecutive days and it hits a new high, the trend follower buys it.
Just because it's going up.
Simply because the observable evidence says the trend is up. And crucially, before they ever buy, they set a predetermined, hard-coded stop loss.
Let's define that clearly. If I buy a stock at $100 and I do the math and decide my portfolio can only afford a 5% hit on this specific trade without damaging my overall wealth, I set an automated trigger.
Right.
If that stock drops to $95, the computer sells it automatically. I don't think about it. I don't agonize over it. I don't call my broker hoping it bounces back. I just take the small 5% cut and walk away.
Exactly. No questions asked, no emotion allowed, and this completely removes human bias. The text gives a great example using Microsoft stock.
Oh, right.
Think about how a traditional retail investor buys Microsoft. They might buy because they read a glowing magazine article about their new cloud computing fundamentals, or they watched an interview with the CEO on CNBC and thought he sounded like a visionary genius.
They're buying a story. They're buying a narrative about the future.
Precisely. But corporate narratives are just stories meant to seduce investors and drive up share prices. A trend follower ignores the story completely. They do not care who the CEO is.
They just look at the chart.
They buy Microsoft purely because the numbers on the chart are moving upward. As Larry points out repeatedly, numbers are facts. Stories are just marketing. The market doesn't care if a company has a great mission statement. It only cares about the raw mechanics of supply and demand.
Which completely flies in the face of the most sacred cow in all of modern finance, the buy and hold strategy.
It really does.
If you go to any financial advisor, the whole industry tells you to just Buy a diversified index fund, hold on to it for 40 years, close your eyes through the crashes, and eventually the market will always go up. They operate on the assumption that the market is perfectly efficient and always trends upward eventually.
But history proves definitively that markets are not efficient, and they absolutely do not always go up.
Think about the massive paradigm shifts in human industry.
Right, like the horse and buggy.
Exactly. If you were a buy and hold investor in 1905, you probably bought stock in the premier horse and buggy manufacturers. They were blue chip stocks. If you held them for 40 years, your portfolio went to zero. The automobile wiped them out.
The trend reversed permanently.
Yeah. If you bought and held the best typesetting companies right before digital publishing was invented, you went to zero. Look at the value of yellow taxi medallions before and after Uber. If you just buy and hold blindly, ignoring the present reality, you are exposing yourself to catastrophic industry shifts. No one can predict the future.
And Larry didn't just guess at this theory. He had the receipts to back it up. His team at Mint, specifically Alex Gracerman and Catherine Kaminsky, conducted what has to be one of the most jaw-dropping, exhaustive studies in financial history.
This blew my mind.
They analyzed 84 different markets over 800 years. We are talking about empirical data going all the way back to the 1200s.
It's an incredible data set. They weren't just looking at modern stocks, obviously.
Right, they were looking at historical agricultural data, 13th century grain markets, early currency exchanges, the price of spices in the Renaissance.
And why did they go back that far?
They wanted to see if human behavior, specifically fear and greed, had changed over 8 centuries.
And the answer was a resounding no. Humans act the exact same way during a grain shortage in the 1300s as they do during a tech crash in 2001.
We are remarkably consistent.
We really are. And what they found in the study was that over 8 centuries, a systematic trend-following strategy yielded a 13% annual return. By comparison, a strict buy-and-hold strategy across those same markets yielded only 4.8%.
Let that gap sink in. 13% versus 4.8% compounded over decades, let alone centuries.
It's insane.
It's the difference between generational wealth and barely keeping up with inflation.
And the craziest part of the data is that trend following actually thrived during the worst financial disasters in human history.
It did.
It made massive profits during the Dutch tulip crash. It returned a 90% profit during the Great Depression crash between 1928 and 1930. How is that even possible?
Well, think about how trend following works. When the market crashes, that is not an anomaly to a trend follower. That is just a massive, highly visible downward trend. The trend follower sees the initial drop, their stop loss gets triggered, they get out of their long positions early to protect their capital. And then, crucially, they short the market on the way down.
They ride the wave down just like they ride it up.
Exactly. They profit from the panic.
So trend following is demonstrably mathematically powerful. But understanding the math on a piece of paper is one thing. Scaling it into a global billion-dollar financial empire requires a different kind of alchemy.
It takes massive execution.
Right. We need to look at how Larry took this theory and used asymmetrical leverage to build the Mint empire.
And the moment Larry really leveled up, where he moved from theory to practice on a massive scale, was the legendary coffee trade of 1975.
Tell me about the context of that trade.
Well, the context here is key. Coffee prices were in the absolute gutter. There was a massive glut of supply worldwide, and it was trading at around 60 cents a pound. Larry does the historical research, looks at the charts, and sees a massive upward trend beginning to form based on changing consumption patterns and some weather anomalies. So he makes a bet.
A calculated bet.
Exactly. He decides to put up $500,000.
Yeah.
But he doesn't just push all his chips to the center of the table at once.
Mm-hmm.
He buys options in $250,000 chunks.
Why in chunks?
Because he rigorously calculated that even if the trade went completely sideways, he could comfortably afford to lose $250,000 without it impacting his lifestyle or his ability to trade tomorrow.
This is the textbook definition of a good bet. He capped his downside strictly at an amount he could afford to lose, but the potential upside of the commodity rising was mathematically uncapped.
Yes.
He was risking pennies to potentially make dollars. This specific structure is what he calls asymmetrical leverage.
And the bet pays off in historic fashion. The price of coffee shoots from 60 cents up to $3.10.
Wow.
At this point, his friends and colleagues are begging him to cash out. They're looking at $6 million in profit and screaming at him to take the money and run.
But he refuses.
He refuses. Why? Because the trend is still going up.
Yeah.
He relies on his rule, let your profits run on. He finally walks away, only when the trend demonstrably reverses and starts heading back down.
And what did he walk away with?
Pocketing $12 million at the age of 35.
It's a massive victory. But what's truly fascinating about this phase of his life is his self-awareness. He knew his own limitations. He knew he was the idea guy.
Right, because of his dyslexia.
Yeah. He had the vision for asymmetrical leverage, but because of his profound dyslexia, he knew he couldn't build the complex computer models required to execute the strategy perfectly across dozens of global markets simultaneously.
He needed help to scale.
So to scale up, he founded Mint Investment Management and partnered with brilliant quantitative analysts, specifically Peter Matthews and Michael Dillman.
They literally computerized his brain. They built complex algorithms to track moving averages across multiple commodities simultaneously.
So it's totally automated.
The computers would automatically trigger buys when trends rose and automatically trigger stop-loss sells when trends dropped.
And the psychological freedom this provided just cannot be overstated. Once the machine is running, human ego is completely removed from the equation.
They literally signed a pact, right?
Yes. The text notes they literally signed a pact, a physical binding agreement promising that none of them would ever, under any circumstances, manually override the computer system. They surrendered completely to the math.
But the true masterstroke, the financial engineering that exploded Mint into the very first billion-dollar hedge fund, wasn't just a trading algorithm.
No, it was a product born at a London cocktail party.
I love this story.
So Larry is chatting with a wealthy potential investor who is complaining about Mint's high fees. The investor says, look, you charge a 2% management fee and 20% of all the profits. That's incredibly steep. I can find cheaper money managers. Why should I invest my capital with you?
It's a perfectly rational question from an investor looking to minimize costs.
Absolutely. And Larry goes home, chews on this problem, and engineers a brilliant solution using that exact concept of asymmetrical leverage. He creates the Mint Guaranteed LTD Fund.
I want to walk through the mechanics of this because it is genius. Let's say an investor gave them $1 million.
Okay.
Mint would take 60% of that money, $600,000, and put it directly into 5-year zero-coupon U.S. Treasury bonds.
Okay, let's pause and explain what a zero-coupon bond is for anyone who isn't a bond trader, because this is the linchpin of the whole scheme.
Right. A standard bond pays you regular interest or coupons over time. A zero-coupon bond pays no interest along the way. Instead, you buy it at a steep discount, and it pays out its full face value at maturity.
Got it.
Because interest rates in the 1980s were incredibly high, you could buy a bond for $600,000 that was mathematically guaranteed by the United States government to be worth exactly $1.2 million in exactly 5 years.
Meaning the investor's original 100% investment, their full $1 million plus Mint's management fees, were completely guaranteed to be there in 5 years, backed by the U.S. government.
Exactly. The principal was perfectly protected. Then, Mint took the remaining 40% of the investor's money, $400,000, and used it to trade aggressively in their computerized trend-following system to generate massive profits.
It's an absolute no-lose pitch. Think about the psychology of walking into a boardroom with that offer. Larry walks in and says, look, worst case scenario, our computers completely fail, we lose the trading capital, but in 5 years, thanks to the bonds, you get your exact $1 million back. You lose nothing but time. Best case scenario, our computers do what they historically do, we ride the trends, and you make an absolute fortune.
Investors practically threw money at them. It exploded Mint into the stratosphere.
I mean, how could you say no?
You couldn't. Larry distills this down to 3 core ingredients of asymmetrical leverage that anyone can use. 1, time. Patience gives you options. The 5-year window of those zero-coupon bonds is what made the guarantee mathematically possible.
Right.
2, knowledge. Having the computerized system and understanding the historical data that others ignored. And 3, OPM, or other people's money.
What?
Using outside leverage to scale your knowledge and time.
It reminds me of the Moneyball analogy that Tex brings up.
Oh, yeah, with Billy Beane.
Billy Beane, the GM of the Oakland A's, he didn't have the massive bottomless payroll of the New York Yankees. He didn't have the money. So he used knowledge sabermetrics, analyzing a player's on-base percentage instead of subjective, scout-driven things like how a player looked in the batter's box to gain asymmetrical leverage over rich teams.
He found a mathematical edge.
Yes. And later, when all the rich teams copied his sabermetrics, he used his knowledge to realize that relief pitchers were deeply undervalued by the market compared to starting pitchers. He found a new asymmetry. He was constantly looking for the gap between the actual mathematical probability and the public perception.
It's about betting on the math, while everyone else is betting on the story.
Now, it's easy to look at this and see how it works with billions of dollars on a trading floor or managing a Major League Baseball team, but Larry insists adamantly that these exact same mathematical rules dictate the success or failure of your personal life, your career, your relationships.
This is where Larry's philosophy hits home for you. Let's look at dating. Larry viewed dating as a literal series of calculated bets.
I love this part of the book so much because it is so ruthlessly logical. Remember, Larry grew up feeling inadequate. He knew he wasn't traditionally handsome. He wasn't the suave guy who's going to walk into a loud, crowded Manhattan bar and have women instantly swooning over him.
The odds in a bar were terrible for him. It was a bad market.
So he changed the game. He went to shopping malls.
The math of the mall is fascinating from a game theory perspective.
Mm-hmm.
First, the demographics. Women outnumber men significantly in a shopping mall during the day. The supply and demand curve favors him.
Makes total sense.
Second, the environment is low pressure, public, highly visible, and safe.
Right. So his strategy was simple. He would spot a woman having coffee alone, looking maybe a bit bored on a lunch break. He would politely approach, be totally respectful, and just ask to join her for a quick cup of coffee.
And because he is a quant at heart, he tracked the math.
He logged the data. He found that exactly 1 in 4 women would say yes to a quick, low-stakes coffee. And of that 25% who said yes to coffee, 1 in 3 of those women would eventually say yes to a proper dinner date.
He completely stacked the odds in his favor.
Mm.
He controlled his risk. A public place, low stakes, low pressure, meaning the downside of a rejection was minimal, and he maximized his opportunity horizon. He kissed a lot of frogs, mathematically speaking, but he guaranteed a steady pipeline of potential partners without exposing himself to the high-stakes ego destruction of a crowded bar.
But the real application of the rule comes after the first date. How do you apply a trend-following chart to a long-term relationship or a marriage?
Well, think about what a relationship actually is. It is an investment of your most precious capital. And your most precious capital isn't money. It's time.
Because you can always earn another dollar, but you cannot earn back spent time.
Exactly. So think about your own life. How long do you stick with a bad trend in a relationship?
That's a tough question.
It raises an important point about human irrationality, specifically the sunk cost fallacy. If you go on a first date and the person is rude to the waiter or aggressively negative, what do? You don't call them again. You cut your loss immediately.
Right. It's easy because you have no sunk cost.
But what if you are 5 years into a marriage and it has become toxic, emotionally abusive, or fundamentally miserable? People will stay in that misery for another 20 years because of sunk costs.
They think, I've already invested 5 years of my youth into this person. I can't walk away now. That means those 5 years were wasted.
But the rule demands that you look at the present trend. The market, or the relationship, does not care what happened 5 years ago. It only cares about today. If the trend line of your happiness, your mutual respect, and your peace of mind is going straight down and hitting new lows month after month, you must trigger your emotional stop loss.
You must cut your losses, regardless of how much time you've already spent.
Conversely, when you find a great partner, like Larry did with his wives Sybil and later Sharon, you must let the winner run.
Often people self-sabotage great relationships because they are secretly terrified. They look at a wonderful partner and think, it can't be this good. I don't deserve this. The other shoe is going to drop.
So they subconsciously create drama to ruin it, just to restore a sense of control.
Trend following says, ignore your fear. If the trend is up, enjoy the ride. Do not jump off a winning wave out of anxiety.
And this exact same logic applies to careers. There is a truly terrifying story in the book about a friend of Larry's.
The teacher in the Bronx.
Yeah. She was a high school teacher in the Bronx, and it was a rough school. Tensions were high. One day, a student literally walked up to one of her colleagues in the building and shot them in the face.
A horrific, traumatic event. And Larry talks to her shortly after, and she confesses that she is absolutely terrified to go to work every single day. The stress is killing her. Furthermore, she admits her lifelong dream was actually to be a psychologist, not a high school teacher.
So Larry asked the obvious rational question, why don't you quit?
And her answer is the ultimate trap of the middle class. She says, I don't want to lose my pension.
Which, mathematically and existentially, is an insanely bad trade. Larry pointed out the stark, morbid reality of her position. She was risking her actual physical life, the ultimate downside, for a hypothetical future financial payout that she might literally not live to collect.
Wow.
She was holding on to a catastrophic losing position because of the sunk cost of the years she'd already put into the pension system.
But she listened to him, didn't she?
She did. She evaluated the worst-case scenario, realized Larry was right, triggered her stop-loss, quit her job, went back to school, and successfully became a psychologist.
It's so logical when you hear it laid out like that. But human beings are incredibly stubbornly irrational. We cling to our pensions, we cling to bad marriages, we cling to losing stocks. Even the smartest people on Earth fail to follow this rule.
Which brings us to Larry's taxonomy of losing. Let's look at how the smartest people actually destroy their wealth.
Larry outlines 8 specific ways people lose money in the markets. We won't cover all 8 today, but we have to deep dive into the most dangerous psychological traps because they apply to everyone.
Trap number 1 is my absolute favorite because it is so counterintuitive. Trap number 1 is be a genius.
It sounds wrong, doesn't it? We are conditioned to believe that the smartest people win.
Exactly. But look at the evidence. The Ivy League graduates, the straight-A students, the valedictorians, they often blow up their portfolios the fastest.
Why is that?
Because their entire lives, from kindergarten through Harvard, they have been told they are uniquely brilliant. They're used to always having the right answer, they study hard, they take the test, they get the A.
But the market does not give a single damn about your diploma.
The market is chaotic. If you are a genius who is used to always getting an A, you will fundamentally refuse to accept when the market tells you that you are wrong. You will hold on to a plummeting stock out of pure ego, because selling it means looking in the mirror and admitting, I made a mistake, I am not perfect.
They lack the assumption of wrongness. A C student is used to being wrong. They take a loss and move on. A genius will argue with the market all the way down to bankruptcy.
Another major pitfall is trap number 5. Hang on. When you're losing.
Oof. The story of Larry's cousin perfectly illustrates this. The cousin bought options in Merrill Lynch stock, and he proudly explained his trading strategy to Larry. I only sell when I'm winning. If a stock goes down, I just hold on to it until it gets back to at least even. I never take a loss.
A strategy fueled entirely by hope. And hope is a highly toxic emotion in investing. Hope makes you freeze when you should act.
The cousin's stock tanked. He lost his initial investment of $100,000, but instead of cutting the loss and walking away, he actually went to the bank, borrowed another $10,000, and doubled down on the losing position, convinced it just had to bounce back.
And he lost that too.
He averaged down on a loser, which is financial suicide.
But we have to be fair here. Even Larry, the pioneer of this entire philosophy, wasn't immune to these traps. He almost lost everything because of trap number 8. Be arrogant.
It's a really somber shift in the book. It's 1979. Larry is flying high. He's acting as the concept guy for his firm, flying on Concorde jets to Europe, bringing in millions of dollars from institutional investors. Because he's so busy, he leaves the daily book balancing and risk management to his trusted partner.
And that partner commits the ultimate sin of trend following. He got arrogant. He thought he knew better than the market.
What happened?
At the time, Paul Volcker, the head of the Federal Reserve, was aggressively raising interest rates to combat inflation. The partner looked at the macroeconomic landscape and assumed Volcker would surely stop raising rates soon. He thought the rates had peaked.
He predicted the future.
Yes. So, based on that prediction, he manually overrode their rigidly hedged trading system. He left a massive billion-dollar options position completely unhedged, exposed to the raw, naked movement of the market.
And Volcker didn't stop. He kept raising rates. The market moved violently against them. Larry gets called into an emergency meeting with his partner and his lawyer. The room is dead silent. The partner is in such despair, he is literally threatening to jump out the window.
When they run the final math, when the dust settles, they don't just have $0. They owe $7 million more than they actually have.
It is total unmitigated ruin.
Yeah.
Larry talks about the physical toll of this. He was physically vomiting every single morning from the sheer stress of the debt.
But this is where that childhood resilience, the kid who couldn't see the chalkboard, kicks in.
Right. He doesn't run away. He doesn't jump out a window. He uses what he calls the power of the weak position. When you are completely destroyed, when you have absolutely nothing left, you can't be threatened anymore. You can't threaten a dead man.
So he takes that weak position, goes directly to the banks, goes to his investors, and he negotiates. He looks them in the eye and says, I have no money to give you. If you bankrupt me today, you get nothing. Zero. But if you let me keep my desk, let me trade my way out of this using my system, I will pay you back.
And they agreed, because they had no other choice to recoup their money.
He faced the music. And the ultimate lesson he took from that horrific trauma was that he could never, ever trust human emotion again. Not his partners, not his own. The ashes of that disaster birthed the fully automated, rigorously enforced Mint computer system we talked about earlier. He built the machine so he couldn't be arrogant anymore.
Okay, so this has been a wild, sweeping narrative. From dyslexic kid to millionaire to bankrupt to billionaire hedge fund pioneer. But we have to bring this back down to earth.
Like, to the everyday investor.
How do you avoid these traps and start building this kind of wealth, even if you are literally starting with $0 in your bank account today?
Larry distills his advice for the everyday person into a very simple mandate. You don't need to know calculus. You don't need an Ivy League degree. You just need to count. You need to look at the raw numbers of your life.
But practically speaking, how does someone even get their first $10,000 to invest? If you are living paycheck to paycheck, counting doesn't magically produce cash out of thin air.
The text provides a ruthlessly simple, almost stoic answer. You must live on 90% of what you make, period.
Live on 90%.
You take the remaining 10% and you invest it. And you have to be brutally honest with your counting. People lie to themselves constantly about money. They get an annual bonus at work. And instead of treating it as unexpected capital to invest, they absorb it into their lifestyle. They throw a $30,000 party, or they upgrade to a car they don't need.
A bonus is extra. Stop treating it like baseline salary.
If you fundamentally cannot save 10% from your primary income because of basic living expenses, get a second job, cut your expenses, save up your first $10,000, and when you finally do, only ever bet $5,000 of it so you never violate rule number 2 and lose all your chips.
It requires intense discipline over a long period. But once you have that capital, you wait for the asymmetrical opportunity. Which leads to one of my favorite stories in the entire book. It is the ultimate modern example of letting your winners run. It's the story of the Mint.com domain name.
It's a brilliant application of the philosophy outside of the stock market.
Back in 1994, Alex Gracerman, one of Larry's quants, buys the URL mint.com for just a few bucks. He just wanted to use it for their internal company emails. Flash forward 12 years to 2006. A young tech entrepreneur named Aaron Patzer is starting a personal finance software company. He desperately wants the mint.com URL for his brand, so he contacts Larry's team and offers them $100,000 in pure cash for it.
Now, stop and think about the math. For almost anyone on Earth, turning a few dollars of registration fees into $100,000 in cash is a massive, life-changing win. They would take the cash immediately and celebrate.
But Larry's playing a different game. He understands asymmetrical leverage. Let's look at the mechanism of his decision. He doesn't need the $100,000 cash. Taking the cash puts a hard cap on his upside. His downside risk is effectively zero, since they only paid a few dollars for the domain.
Right.
So he looks at Patzer's company, sees a massive upward trend in the business model of online personal finance, and says, no, keep your cash. I want 2% equity in your company, and I want anti-dilution rights. Meaning, as the company takes on venture capital and grows, his 2% can never be watered down.
Patzer eventually agrees, and the punchline is a masterclass in letting a winner run.
In 2009, just 3 years later, Intuit, the makers of TurboTax, buys Patzer's company for $177 million. Larry's 2% equity stake instantly translates into a $4 million payout. He turned a $100,000 capped cash offer into a $4 million uncapped payout simply by refusing to cut a winning trend short. He rode the wave all the way to shore. And, true to his character, he donated the entire $4 million to charity.
The philanthropy is admirable, but the mechanical lesson is what we need to focus on. When you have a winner, whether it's a stock, a business, or a piece of digital real estate, you do not panic sell just to lock in a small, comfortable profit. You let it run until the trend objectively reverses.
And doing that requires a very specific emotional temperament.
Which brings us to the final piece of Stoic wisdom from the text. The lesson of the bomb squad.
This is so intense. Larry had a colleague at Mint who used to be a colonel in the British bomb squad. Literally the most high-stress, high-stakes job on planet Earth.
Larry asked him once, "What do you do when you walk up to an explosive device and it's a design you've never seen before? You have no idea how it's wired and the clock is ticking."
And what did he say?
The colonel replied, "You record your first impression and you hope it is not your last."
Wow, just raw, objective observation in the face of death.
The application to investing and to moments of crisis in life is profound. When the market suddenly panics, when a black swan event happens and everything in your portfolio is plunging, your lizard brain will scream at you to panic. It will scream at you to sell everything and run.
But you don't panic. You act like the bomb tech.
You record your first impression, you look objectively at the data, you trust the mathematical system you built when you were calm, you check your predetermined stop losses, and you act with cold, rational precision while everyone else around you is screaming and making emotional decisions.
It's about violently detaching your ego, your fear, and your hope from the mechanics of probability.
You have to become a casino, not the gambler.
So, to bring this massive journey all together, the trajectory of Larry Hite is just incredible. From a kid in Brooklyn who literally walked into walls because he couldn't see, who was told by his own parents he would amount to nothing, to a Wall Street wizard who saw the mathematics of human behavior clearer than almost anyone else in history.
He didn't win because he was a genius who could see the future. He won because he expected to lose. He planned for failure, and he built a mathematical system that survived it.
Know your flaws intimately. Get in the game. Never, under any circumstances, bet your lifestyle on a single outcome. When a trend turns against you, cut your losses immediately, without ego. And when you catch a wave, when you find a winner, have the courage to let it run.
Which leaves me with one final kind of provocative thought for you to mull over as we close out. We opened by talking about how messy and murky the world is. But if we truly accept Laurie's premise that success in life, love, and money is simply a matter of managing probabilities, hacking multiple choice tests, and ruthlessly cutting losses, how does that change our cultural obsession with destiny?
How does it change our belief in soulmates? If fate isn't written in the stars, but is actually just a Bayesian math equation waiting to be solved, what happens to the romance of the unknown? Are you brave enough to strip away the story, look at the cold numbers, and treat your own life as a series of calculated bets?
It's a daunting perspective, but ultimately a deeply empowering one. Thank you for taking this deep dive into the sources with us today.
Keep counting, know your odds, and always let your winners run.